Okay, folks, welcome back. This is our weekly review for the weekend edition of the ICT Mentorship. All right, we'll be looking at the economic calendar real quick here. On Monday, January 13th, medium impact GDP for cable for London session and manufacturing production. 10:30 a.m. we have Bank of Canada Business Outlook Survey. It's high impact. Tuesday, New York Open, high impact CPI and core CPI for dollar. Wednesday, London Open, high impact CPI for GBP and PPI. 8:30 a.m. we have core PPI for the dollar index. And 10:30 a.m. on Wednesday we have crude oil inventory. So Canadian dollar will have some response to that report on Wednesday. On Thursday, London Open, we have a medium impact credit conditions survey for GBP, and 7:30 a.m. high impact ECB monetary policy meeting accounts for Eurodollar, and 8:30 a.m. on Thursday high impact core retail sales and Philly Fed manufacturing index. Friday we have high impact retail sales for GBP in London session. New York Open, we have medium impact dollar building permits, and 10 a.m. we have preliminary consumer sentiment, medium impact for dollar, and then tentatively we have a treasury currency report. Okay, so we have the dollar index as our daily chart here, and as I mentioned in our midweek review, we probably want to see it make an attempt to get up there still and run that buy side liquidity. I still think it favors that. It may need to come back down into our fair value gap as outlined here, right in here. It doesn't need to do that, but if it comes down here, I would expect some sensitivity here, and then maybe send it to these relative equal highs. Again, for a long-term bias, I don't change to long-term bullish again unless these highs are taken out. Right now, this is just a short-term volatility expectation to get these stops here. Now, it may run up here and then change the entire structure of the market and then send it aggressively lower after taking these buy stops. Or we run through that and then come back and find some support here at this breaker right here, because we have a low, high, a lower low. So how we trade at these highs, okay, it's one of those moments where I'm waiting for more information and how it trades there. Okay, so we'll talk more about that should it in fact get there at all, because we obviously don't know for certain if it's going to go here. But if it does, that's the criteria I'm looking at, weighing out. Plain and simple, so that way I'm not being ambiguous or confusing to anyone listening. I'm expecting 97.85 to be traded to. Okay, that's what I'm looking for. Do we go straight from there at the open on Sunday and Monday? Or do we come back down into that 97.10, 97.20 level? That remains to be seen. But it's beautiful to see such a reaction off of our BISI in here. Buy side and balance, sell side and efficiency in the form of a fair value gap. Came down, beautifully filled that, found some support at it again and rallied up. Again, discounting this wick in here. I'm more concerned about this low and the high in between, not so much this, okay, as I mentioned in previous recordings. We are inside the bearish order block, okay. We traded up into that on 2 occasions, and I want to see if they offer a trap for shorts. Okay, in other words, are they looking to send this thing lower quickly on the jump at the beginning of the trading week and then send it higher as a result later on? That's the scenario I'm kind of anticipating. I'm looking for that to actually unfold. It's January, folks. Okay, I'm sitting on my hands. I'm not in a hurry to get in here and start trading. I want the markets to iron out the holiday volume still. So all I'm doing is giving you my opinion, like I always do, but I'm not going to act on any of this. So I want you to be very careful about listening to what I'm saying, and I'm not trying to sweet talk you into doing anything, okay? Remember, this entire month, we are in Intel only, okay? We're collecting information. We're not trying to jump in, with both feet. We're slowly sticking our toe in the water to see what it is most likely going to do for the next couple months. That's where our focus lies for right now. Dropping into an hourly chart, that fair value gap, if we take a look at that, we have a 20 level, 97.20, in here with a bullish order block that is just below this area in here where there could be sell stop liquidity or sell side liquidity in the form of sell stops. And then we have a fair value gap down here right below an old low as well at 97.06. So either of these two levels in here may be in play this week. I'd personally like to see it find 97.20 as a reaction and not come all the way down here, because everybody is expecting this high, and this high, and this low to be the classic support and resistance scenario. It would be natural to assume that, but I want to see the institutional level be defended, and then I'll go send it to 20 and then send it higher, attacking that 97.71, which is the old 2018 high. And on a 15-minute time frame, those same levels here just amplified. You can see a real clear sell-side liquidity pool rests below here, even though it's not annotated. And again, if we drop down into the 15-minute time frame, we have a smaller bullish order block in the form of these two consecutive down close candles, and that would set us around 97.16, 97.17. So that still could be the, I guess, the short-term volatility that would extend through 97.20 and not get to 97.06. Okay, I'm not saying that 97.06 is a bad thing. I'm saying that it's better for me to see it trade 97.20 and then find some support, and I can wick through that down to 97.16, 97.17, and everything would be still normal in my expectation of looking for it to go higher, because we still have relative equal highs in here. So buy side liquidity rests in the form of 97.60 still. Moving on to euro dollars is our daily chart. You can see we have a fair value gap in here. We traded up into on Friday. Didn't quite close it completely, but we did get up into consequent encroachment and a little bit higher than that. I like the sell side liquidity pools that rest below here and in the fair value gap here in the form of a BISI, and then a larger pool of liquidity here. So I want to see, do we have the, I guess, the energy to send euro dollar all the way down here? Because if it comes down here, I've said this in the past myself, if it comes down here, it's not going to look really bullish, but that could be a beautiful setup for a longer term quarterly shift where they take the liquidity out and then start to send it higher, where all of this was just, I guess, premature attempts to go higher. As I noted here, multiple failed rallies. But if we come down and take out the liquidity, or at least the very minimum, clear up this in here, I'd like to see it do that. It can come down, basically touch the top of this fair value gap at 110.40-ish or thereabouts, and then ultimately make another attempt to go higher on a longer term basis. There's a lot of folks that are looking for continuation patterns in here to go long, because they're looking at higher highs, higher lows type scenario. I'm not looking for that. I'm looking for them to take it lower to clear the board on any longs that were accumulated from here and back in October. All right, taking a look at the hourly chart here on euro dollar, you can see that we have the SIBI here, sell side imbalance, buy side inefficiency, to come all the way up into consequent encroachment, almost completely filled it in, then sold off. Then we have an immediate rebalance. So I'm just showing you again with annotations the difference between the two. From the open, immediately rebalancing, so that's immediate rebalance, and then deferred rebalance, which is a classic fair value gap. The little eyeballs in here just to draw attention to specific things. I don't want to clutter the charts up. So when we go forward, whenever you see me having an eyeball in our annotations, I'm not trying to draw your attention to anything specific. I'm going to talk about the things I want you to see in regards. It's just a mental note for me to remind myself to talk about specific things, because sometimes, because I don't have a script, I have bullet points that I want to talk about in reference to specific markets or ideas I have. And invariably, because I don't have a script that I'm reading verbatim, which you would hear me sound like a robot. I've done that in the past in tutorials when I was doing free tutorials. It's too stilted for me, and I don't feel comfortable doing that. So I like to be able to speak from experience, and that's the reason why it sounds fluid. The problem with that is I have a tendency to overtalk, and that's some of the things that people complain about because they want me to get right down to the point. And the problem with that is I have so many points that I can make. I have to build a specific narrative to understand future lessons or future ideas that I think are going to pan out in the marketplace, and still not provide teachings to lower level members that haven't gotten that far yet in the lessons. Okay, so it's a lot of balance and split, plate spinning, basically. I've said this in the past many times as an analogy. I have to do a lot of things to keep you all moving along in progression through the content, but not make you skip so far ahead that there's a great vast, difference between where I last spoke about something and then now I'm bringing in something else. And there's a huge chasm in between what you heard me say and what you should understand between the two. So anyway, just know that going forward, the eyeballs are just, for me, I know what I'm going to talk about when I see that, because invariably, if I put a lot of notes in here, because I could talk literally for about 3 hours all about what's going on in here. And some of you that would listen to that would be obviously improved because of it. And others would be like, okay, I'm month 1, month 2, this is over my head, this is too much. And it would scare you. Okay, it's like there's too many things to know about. And you don't really need to know all that. Okay, mentorship is to teach you a greater deal of clarity and depth of price delivery. You don't need a whole lot to be quote unquote profitable in speculation, but you do need to know where the problems will occur, the pitfalls that's going to cause you to go into a tailspin and drawdown or uncertainty will creep in. The fair value gap that I had on the daily chart, this is that rectangle here, that's what's being shaded in. If we break that down inside of all of that, there's really nothing in the form of a premium array with the exception of old lows here and here. And I showed you some things about that. I think it was, I don't know if it was the last recording now as I'm thinking about it. If it wasn't that one, it was the previous recording where I showed the layered liquidity and open float demonstration of how the algo reaches for specific points of buy side and sell side liquidity in the form of open float and layered liquidity. So you can do that exercise with this low here and this low here and see if anything frames out with that. I'll leave that for you for your homework. But these levels here, this line and this line, okay, that is that old fair value gap on the daily chart. And again, I've kept it on here this long just to show you how IPTA will remember that. We had trade inside of that range, come back above it, sweep a little bit, and then we came down to consequent encroachment, came back up near the top and end of that range, and then came right down to the bottom of it. Nice little sensitivity shown there. That's a trade from this level all the way up to consequent encroachment and expanding. That is a scalp. You could do that, and you can do exercises on that. Dropping down into the low end of that old fair value gap again, price hits it, it shows a response as well. And then here's what I wanted to talk about. Look how much activity is around the consequent encroachment. Okay, that means basically the middle, the high and the low of that fair value gap. That's an old fair value gap on the daily chart, but it's still active based on the IPTA data range. So it's still useful, it's still pertinent, it's still salient to current price action, as you can clearly see. But look how much time it spends around consequent encroachment and then makes an aggressive run below relative equal lows. Sweeps below that, then comes back up and hits the top end of that old fair value gap. And look at the bodies of the candles, really respecting that. That to me is very interesting, okay, because you'll see these types of scenarios pan out over and over and over again if you keep old fair value gaps on a chart. Now again, you don't want to keep old fair value gaps and old PD arrays on your charts that are being looked at daily. Okay, you want to keep a chart that's specific to a specific time frame and then refer to them. That way it's another resource you can go to that's completely supporting other ideas that would more or less dovetail with your analysis, that would be done on a clean chart or like when I show you my daily chart, it doesn't have a whole lot of business on it. Okay, it's the things I want you to focus on at the moment. I could dress it up and have 1,000 different things on that chart, and you'd walk away feeling like, wow, it's really interesting how he has all those things on there, but what am I supposed to do with it? That's the reason why I only have a few things on my charts, because these are the things that are pertinent to right now, and the things that I'm leaning on in terms of my directional bias and why I believe it's going to do what it's going to do. So I do a lot of trimming back on my charts. Now, admittedly, in my own journals, there's a whole lot more references to certain things in here. And again, it's not that I'm hiding anything from you. I'm controlling the amount of information, because if you get too much information, you're going to look at old things in charts that I will look at when price gets close to it, but you'll assume that there's a whole lot more significance to it and do something you'll regret later on. Okay, so again, I'm using my experience and taking personal responsibility for the opportunity that some of you are not going to listen to the agreement when we came into this. This is not a trade signal provider service, okay? But I know some of you can't control yourself. And invariably, you're going to go into the marketplace and you're going to do something that I've advised you not to do, okay? And you signed an agreement understanding that. And what am I saying? I'm going to come out and say it. Some of you go into this watching my reviews and you go right out there and you start trading with live money. Some of you have reported great success. I don't respond to those emails, if you notice that, okay, because you're really not listening to me. What I'd rather have you send me is, I watched this and I monitored it and it was a positive study. Okay, that's the type of response I'm looking for, because I'm not interested in you making money. Okay, because anyone can make money. What I want to see you do is be controlled about your decision making, your expectations on the market. The analyst, I'm creating the analyst in you. The trader is somebody that you're going to have to evolve into beyond me. But the analyst is going to keep you above water. He's going to keep, or she's going to keep you in a position of sober-mindedness and not reactionary, not chasing the money, not chasing a higher bottom line, not running an equity curve. That's not what this is about. All of those things are derivatives, okay? And by default, they will become the standard and norm. But you can't acquire that until you have a level of experience and you've pruned your attempts to grow faster than you should, because you're in a situation, and I can relate to that because I was like this too. I wanted to get out of the rat race so bad I couldn't stand it. But if you try to rush it, it just makes it further away. And it sounds like it's impossible. Like, no, I'm going to work harder. I'm going to work faster. I'm going to do more. And I'm going to trade sooner than I should. And I'm going to just chance it, because if I make a little bit of money, it'll just help me along. It'll make me feel better about doing it. And it won't. It won't. I'm telling you, it won't. So this is the reason why I tell everyone you have to submit to this time element, because once it becomes boring and you know exactly what you're looking for and it pans out every single week, man, then you're in a situation where if it's feasible for you to move into live trading, you'll know when that's going to be appropriate for you. I don't ever tell you when to do that, okay? But anyway, I want to see if we get, after running the buy side liquidity resting above this area in here, I want to see if we show a willingness to drop aggressive now, okay? And if we trade above the fair value gap, that to me may be indicative of the market wanting to go higher, and therefore the dollar should, at the very least, have a deeper correction lower this week. But I'm just weighing that on the basis of the fair value gap that's being shown here. Moving down into a 15-minute time frame, that same fair value gap just amplified over the course of a 15-minute time frame. Again, the deferred rebalance in the form of a fair value gap, and then the immediate rebalance. Study this in here in relationship to what was shown on the hourly chart. You would not see this, okay, if you were just staring at a 15-minute time frame. This is the reason why when you're looking at your charts, if you're monitoring live price action, you have to transpose your higher time frame PD arrays down into the lower time frame charts. Otherwise, you will not see a fair value gap or an imbalance or anything. You might see just simply the bearish order block, and that would be nothing wrong with that. But it builds strength and more or less validity to the bearish order block when you have the fair value gap below it, which is only seen on that hourly chart. That's the reason why I take you through the natural progression of the daily chart. Now, we jump over the 4 hour because it's kind of redundant. I'm not saying don't use a 4 hour chart. I'm just saying that the videos would be even longer if I did the 4 hour chart too. And that's why I took the 5 minute chart off too. So we just go from daily 1 hour to 15-minute time frame. I think that's a really good framework for those that are just starting, and you may end up keeping this as your routine. You may never look at a 30-minute chart. You may never look at a 4 hour chart. There's nothing wrong with that. Okay, we have rules that are simple guidelines in terms of doing top-down analysis. But as long as you're doing a natural progression from a higher time frame daily, and every quarter you want to take some weekly PD arrays and apply it to your daily charts. And if you're really aggressive, every single week you want to take a look at your weekly chart and then transpose any new or newly formed or approaching premium or discount weekly chart PD arrays. And I'll say that again. Once a week, or at the very minimum every month, you want to be doing your weekly analysis and transposing weekly PD arrays. Okay, that means like your bearish order blocks, your breakers, your fair value gaps, all of those things from a weekly chart, bring it down to your daily. And then those are carried lower, because as long as you put the annotations on your higher time frame chart and you drop down to lower time frames, you'll see the annotations on the lower time frame, and it'll give you a whole lot more narrative that would otherwise escape you if you weren't doing it. So study the immediate rebalance in here, because this is not going to jump off at the chart at you unless you have done so on an hourly chart. Okay, now just for completeness sake, I'll show you it again. This is that immediate rebalance. We have the big down close candle here. The next candle, it opens and it immediately rebalances up to that point and then goes lower. This gap immediately is filled in, but you wouldn't know that from a narrative standpoint looking at it here. It would just simply look like you're trading back up to a bearish order block, and that's it. But there isn't. It's the immediate rebalance. You don't see it because it has this long wick here, then a long wick here, and then it runs up in here. It doesn't look like it needs to do anything. But on an hourly chart, it's a different imbalance. Okay, so that's why we take a top-down approach. We move from a higher time frame down to lower, and price delivery will be more precise because of doing it like that. And again, here's that buy-sell liquidity pool, as I mentioned on the hourly chart. I didn't have the annotation, but you can see it here now. Again, focus on how much time it spends at consequent encroachment between this high and this low of the old fair value gap on the daily chart. Wicks through, spend some time trying to go lower, seeking liquidity below it, and then it runs above it. So now what I'm going to show you is look at the attempts to hug the top of that line, all in here. Look at that. Okay, these are the types of scenarios and signatures that I saw in price when I started taking what I've learned from the interbank algorithm and applying it to price action. I would see these types of things in price, and I'd say, that wouldn't necessarily be a classic support resistance idea, and it doesn't really fit in any kind of other pattern. It just, to me, it was an anomaly. But the anomaly started occurring a lot when I would keep specific things on my charts, like the old fair value gaps. Once they're filled in, we don't discount them. Okay, other people, other traders that understand imbalances and such, okay, by different mentors, most of them came from me. The idea is once it's filled, forget it, it's over, or that one's done, next. Okay, and you can have that mindset. Okay, there's nothing wrong with that, because if that's your model, you're looking for an imbalance to rebalance. Okay, great, boom, done. Next setup. The higher order of analysis is keeping it in your conscience, because just like we can see it reacting here, the algorithm is going to go back a specific number of days and refer to it still. and then after it expires because of the if the data range, then it could still be sensitive, but I'm no longer paying attention to that one. Okay, and that's the reason why I taught if the data range, is because there's a structure in how long and how far back I consider it. I got a question by one of the members if a PD array is considered beyond the highest IPTA data range that you'll learn about when you get to that content level, because I've mentioned other PD arrays that are beyond the scope of an IPTA data range. Why am I doing that? Because it would be considered external range liquidity, whereas this is all internal range because it's inside of the range between the high and the low that's formed. Anything beyond the scope of an IPTA data range, okay, naturally puts us in the contention for external range liquidity. Okay, and I haven't touched a lot on that, but there's a lot of information that goes along with that as well. Like I said, folks, you're in here as a community. You're in here to learn for years. Okay, it bothers me. Okay, it really, I take it very personal when I have members in here that go on Twitter, okay, and say, I'm from your original group, and you are doing really good when you do your reviews and your analysis on a higher time frame, but you confuse your students and you leave them in confusion with these lower level time frame entries. If you're referring to what I did by running up the $5,000 account to several $1 million, okay, that is not going to be taught to you. Okay, I'm not going to teach that. That was the whole reason why I'm not showing any track record. I'm not doing any of that stuff, because that's my baby. That's my personal algorithm. That's Enigma. Okay, I've already told everyone in here, I'm not teaching that. Okay, it's too good to be shared for anyone. No, not at any price. I'm not doing one-on-ones. There's never going to be a future sale. I'm going to teach it to a few people. None of that stuff's going to happen. Okay, but I am offended greatly that someone in this group, if they are, I don't know. I didn't research. You have too many people in here now for me to go through and start looking at Twitter accounts and figuring out if this person really is a member. I don't care at this point. I have so many people now. I don't have time to be doing all that. But if someone sends me an email, I have to research and see if they really are a member. But the mentorship teaches you lower time frame entries. Okay, I've taught day trading. I've taught scalping. I've taught short-term trading. All of that stuff works, and it's very specific. It's not ambiguous. It's not, well, what do I do here? The problem with the members that are at charter level now, that are twiddling their thumbs and not really knowing what to do, is because they're like a dog in a meat market. They have all these models in front of them. They have all of these concepts and all of these time frames that their platform allows them to reach for. Hourly, 4 hour. Now TradingView has the ability to do 2 hour charts, 3 hour charts, 6 hour charts, 8 hour charts. Okay, and you're all just, you got too many things in front of you. And that's a normal thing, okay, because you have a lot of moving parts. But charter members, we're gonna be seeing this weekend the first trading plan, and you're gonna see it's not difficult to take the things that I taught and not apply every single thing, okay? Because that's not what I do. I don't take every single thing and demand everything that I talk about has to speak in a line, like all the planets have to come into alignment. And it doesn't work like that, folks. You only need a specific criteria to find a model, and these models are not cast in stone. Like you could have a myriad. I could do 60, 70, 90, 150 different price action models out of what I taught you. You're limitless. You really are limitless. So it's normal for you to have this overwhelming sensation that I have all this stuff. I know a lot of stuff, but I can't make money. Well, it's because you haven't reduced it down to the specific stages in an algorithm. What is an algorithm? You ever considered what it is? Like, some of you are asking, what is the algorithm? What is the algorithms that you're going to be teaching? What's the stuff you're going to be teaching us? Have you ever made a specific recipe or followed a specific recipe for a dinner entree? That's an algo. That's an algorithm. It's a step-by-step process leading you to a expected return. And if you follow the algorithm, the expected return, the trust and faith is that that outcome will be very close to, if not the same thing, each time. Now, if I was to give you a recipe to make grilled cheese sandwiches, there's not a lot of ingredients in that, but you could live on it It may not be a healthy diet, but you won't starve. Now, if I take and I give you a recipe for a full course dinner with all the fixings, obviously that's more appealing, but you're going to have a whole lot more moving parts and a whole lot more things to monitor. Okay, so my algorithms and the trading plans that I'm going to be giving you in charter members are going to be like grilled cheese sandwich recipes. Okay, you take this in this order, you do this, and you wait for this, and there it is. It's done. It's not going to be very detailed. It's not going to be high and lofty thoughts, okay, that make you ponder about, which one you're going to wait for. It's very simple, okay, and that was the approach. I give you a lot of information, a lot of content, because I'm giving you the flexibility and the opportunity to develop as your own trader. I could make a mold and say, okay, this is the trading plan, this is the model, you have to follow everything like this. And more people would have quit. More people would have been frustrated because it would not have aligned with their personality. When we look at price action, and I've given you tools and concepts, it allows, by the natural order of it, your personality is going to shine through. And that's how you make a system or a method that you'll be committed to, because it's your personal fingerprint in it. Yes, it's my content. Yes, it's my concepts and my instructions, but you are uniquely in control with what you're going to use as a catalyst for your framework and your trade and your timing, what sets the stage for that plan or model to even be considered. Okay? Some of these models are not going to ever be traded by you. And I said that in the beginning. Others, you'll have probably one or two that you really want to cling to. Others are simply saying, I like models 6 and 7 because that's ICT's models. That's what he trades. I can trade anything in one of them. I can trade things that I haven't taught you either. I'm just saying, out of the models, the ones that's closest to what I do is 6 and 7. But there's really no advantage over one or the other. I mean, if you're looking for a consistent approach to finding setups and price action, all of them deliver that. All of them. And they're not limited to the time frames I taught them in. So think about that and let that broaden your horizons, because price is fractal. Everything that I teach promotes flexibility on your part. And while all of you are seeing the same 12 models at charter level and in the respective trading plans, the algorithmic principles behind them, you will all have a different affinity for them. And you'll be able to grow and apply some measure of uniqueness and your personality to those basic models. And even when they're in trading form or trading plan form, and I give you the algorithmic principles behind them, they are complete from my standpoint. I won't do any more tinkering with them. I won't apply anything more to them. I won't give them more substance. They'll be left as they are when we complete 2020 for the charter members. Then it's your job to go in and test them, and then you'll have the very specifics of, you do this, you wait for that. When this information is provided to you, or if this occurs in price, then you do this. It's a simple, like I said, it's not complicated. And you will see just how easy it is to take the principles that you've been shown as a whole and reduce it down to actionable procedures, a very specific routine, and a recipe for continued success. Finally, moving into GBP, this is our daily chart for cable. And we have the buy side liquidity pool and the sell side liquidity pool, as mentioned in the last two recordings. And we have fair value gap, which did, in fact, on Thursday come down and fill that in, as we expected, beautifully. And rolling into an hourly chart, you can see the buy side liquidity pool and sell side liquidity pool, respectively, here. I believe at the moment of this recording that because the dollar index, my analysis is leaning to that daily buy side liquidity pool as a draw on liquidity. I'm looking for evidence to support that as a narrative for this week. Because of that, I'm expecting this sell side liquidity pool on cable to be the draw on liquidity. Now, it may not be the entire run to it this week. It may be a staggered. It may require us beyond Monday through Friday of this week, but I think it's reasonable to expect it to try to get down here. So that's what I'm opening up the week with my mindset. Again, I'm not jumping on it. I'm not shorting cable. I'm not trying to do any trades. I'm looking for it to take place. Now, by me saying that, what I do in January is I look at these types of scenarios, and sometimes they won't pan out. Like before I started doing the mentorship, there was a lot of times where I would look for certain things in January every year to more or less unfold, and they wouldn't. Now, if you are in here learning this under me, and I try to tell you this and say, okay, I think the sell side liquidity pool below 129 big figure is the draw on liquidity, and we possibly have about 150 pips potential move this week shorting cable, and then it goes higher. Well, right away, because you're new or undisciplined, you're going to think right away that there's nothing to this stuff. It's all baloney. I don't know what I'm doing. I'm a fraud. I'm a fake. This stuff doesn't work. There's no consistency. No one knows how the market's going to trade. Forgetting all about the context of January being the type of month, because it's brand new. There's a lot of rotation. Money is pouring in still because people are collecting money for this year's investments. So all of that is being considered by me every year. And there's a lot of moves. If I were to be honest with you, and we were sitting in a room together talking, just chatting, there's a lot of moves in January that I wish I would have participated in and I saw coming. In the last 27 years, there's been lots of January movement that I wish I would have been a partaker of. But equally so, and more so, on the contrary, I'm so thankful that I was watching price and not really participating in, because it's a time when I'm generally wrong a lot. And it's not because of the system. It's not because of me. It's not because of the concepts, they're figuring it out and they're not going to let it work anymore. It's the underlying pinnings of the market that I've just become very comfortable with, allowing the market to build its narrative for the first quarter, and I give it the entire month of January. Now, as a teaching personality and someone that acts in the form of a mentor and teacher, and I charge people to hear my content and my views and opinions, that may be a little bothersome for some, especially if you're new and you're just really an infant in terms of understanding what the markets are. It just doesn't feel right. And for folks that's been here since 2016, you know the routine. We go through it, and you've been here long enough to know that we hit our stride really in the months of May, and then we have a real good run for the rest of the year, and then in fall it's good again. You know the routine. We know our hot spots, when we're going to be, or at least when I'm going to be cold-handed. In January, I'm cold-handed. Okay, I just don't trust the market to deliver as perfectly as I would like it to do. Now, that sounds like a demanding and high and lofty thought. There's nothing perfect. There's perfect, okay, believe me, and you've seen many examples of it when the markets are primed to do so. I don't personally subscribe to the view that in January, just simply because we have a new year and time available to us, that we should get in there and start plowing away and looking for trades. We analyze, we study, and that's what I want you to remember going into this, because I don't want you thinking, well, ICT just gave me a code word to go short on cable and try to make 150 pips. That's not what I'm saying here. We're looking at this, and I'm giving you my opinion that I think that it has the likelihood, given the fact that the dollar could run its daily bullish buy-side liquidity pool. The sell-side liquidity pool here would be the draw on this particular pair, and I prefer this pair over euro dollar. Okay, so I think this pair has a little bit more going for this specific view, in my opinion, than the euro dollar does. So my focus will remain on GBP for this week. The eyeball is simply, again, look at the control of all the bodies on this fair value gap from the daily chart. Now we're going to go into another hourly chart, and this is the level. There was another line here, but I took it off because it was a little bit confusing. But this candle's high right here. We had that out there as well. So there was two BISI, okay, in form of fair value gap. This one here, and then this one here. Beautiful, beautiful delivery of price right in here. Okay, so one of the hot topics I like to do on Twitter is I like to stoke fires and get people thinking. And I just recently did it like I did on previous Fridays for the last couple of years. I like to get people in a frenzy, okay, in a debate, because I want them to think about what they're doing and what they believe in. And I meant this. Support and resistance is a fallacy, okay? Because if you look at all the turning points on this chart, not every single one of them gave you another setup. Not every single one of them. And you can look at this high. You can look at each of these highs here. You can look at this low, this low, this low, all these lows. All of them would be defined as a measure of support and resistance by a classic technical analysis book, okay? If you looked at John Murphy's the Technical Analysis of Financial Markets book, which I think is expected to be in everyone's library, because if you understand everything in that, you just turn everything upside down in there and you can trade against retail. Okay, so a lot of folks heard me say that in videos in the past when I was doing free tutorial stuff, and they would hear me say, John Murphy's text on technical analysis of the financial markets, and they go in there and they start saying, they start sending me emails. Look at this bull flag, and look at this head and shoulders, and all that stuff. And you obviously know in the mentorship we decimate all those types of things, but nonetheless, they naturally go into it and they start sending me emails of frustration saying, hey, look, I don't know when this pattern is going to work, blah, blah, blah. And I just respond to them and say, look, in the mentorship, I talk about how to use that as a weapon. It's not an invitation to make money with using that, but it is an invitation to make money fading that stuff. And support and resistance is one of the greatest fallacies in technical analysis, because we can go back in time and say, hey, look at this old support or this old resistance, and look how it offered a trade here, okay? And the market's not trading on that basis. It's not. It's absolutely not. And if anyone is in here thinking that still, and you're a charter member or claiming to be a charter member, you've missed the boat. Go back through the mentorship again, because you did not pay attention. And if that offends you, too bad, because I'm telling you, I explained in nauseum how we find real quote-unquote support and resistance. And we have been beating the fair value gap for months now. And this is an example of it here. Why did it go lower than this high here? It went lower than that. It went down to this one, so somebody could say, well, see, this is the one that it worked on. That's not what's going on. The imbalance is what it's going back down into. IPTA's going down to offer sell-side liquidity because it didn't efficiently offer it here. It has nothing to do with this old high. It has zero to do with this old high or this high. Okay? There is a great deal of contrast of what you're learning here versus the crap that is constantly talked about, showed on Instagram, classic chart patterns. Look at these. These are the keys to the kingdom. That's bull. It's crap. It's nonsense. Okay? I can show you a myriad of classic support and resistance and classic continuation patterns or classic reversal patterns and plug them into scenarios that you have learned when not to listen to that stuff. In fact, you're not even looking for it many times, but it'll jump off the chart after the fact. Say, oh yeah, I can see how the retail would have seen, oh, that was a bull flag, but it really wasn't a bull flag. It was up. Well, here you go. Run up, consolidation, expect to go higher. It gives the buy side liquidity pool here, punches up, S&P divergence, boom, runs for the support. Or what? No, it's the liquidity, the sell side liquidity. It's not running down to an old low to the bounce. Why didn't it bounce here? Come on, those individuals that are in here that are champions for support and resistance. I know I'm being facetious. I'm making a point here. We don't believe in support and resistance, and you see that I don't ever rely on it. I'm looking at an algorithmic principle that price is delivered, it's controlled, it's manipulated, it's 100% predictable. The problem is there are certain times of the year that it is a little bit more difficult for me to be consistent. And because I'm more or less of a perfectionist and I'm very egotistical, admittedly, and that's the reason why I keep Twitter. Otherwise, Twitter wouldn't be a part of my life. But I vent my arrogance on Twitter versus allowing myself to carry it into a trade or the markets, because that's where it hurts me. And the people in the public, they have no idea that that's what's really going on, even though I've said it many times. They just think that's naturally me, and I'm parading around like, like a dimwit, flipping around trying to be, peacock. Now, I do that facetiously to my wife because you're all married. Okay, some of you probably are married, I'd say it that way. And you like to razz your spouse. So I do it all the time because my wife is very quick to, roll her eyes if I say I've done something that I thought was going to happen. And she more or less isn't impressed by all that stuff. But I do it just to, ruffle her feathers. It's just the same way I do on Friday nights on Twitter. I do things to get people thinking, because number one, you're not going to convince me what I'm showing and what I'm teaching, what I'm living on, okay, isn't the truth, because it's the truth. There's nothing ambiguous about the things that I'm showing here. The problem with this, and I'm going to correct the individual that was on Twitter that said, no, I can see you doing it on higher time frame commentaries, and it's highly accurate. And I'm paraphrasing. I don't know exactly. I'm not going to go to Twitter to read it verbatim, but the problem is, there is no problem. This person's showing this individual's own problem, and there's a deficit here, and it's because they haven't studied enough and listened to what I said, not just in one video or a specific topic of a month, the whole thing. That's why you can't go through the mentorship one time and say, I've gone through the mentorship, I've completed it. It's cringy when I see people say, I've done ICT's mentorship. I'm not done. What are you talking about? You may have watched every possible video, but you have not completed the mentorship. You have not. Here's how you know you've completed the mentorship. When I say I'm not teaching anything new and we're just doing commentaries. That's it. That's when you completed the mentorship. Otherwise, you're here. You're a student. You're active. Okay. Now, if you think that it's going to be short plug-in and you're out there in 6 months and you're going to figure out what you've been looking on, it's not structured that way. I structured this mentorship very, very specifically to prevent anyone from coming in thinking they figured everything out, not because of my own greed, because I want to get everybody's money. Okay. It's a matter of responsibility, because I can teach an order block seminar. I can go on YouTube, and I'm going to do this. I'm going to talk about an order block theory, and watch how these things send people into a frenzy, creating videos and YouTube channels. It's going to go all over the place again. Okay. And that's okay. That's cool, because it's really just going to be advertising for me. But nonetheless, you're going to see how folks just jump on one thing and they make a mountain out of it. But they're going to hide, like everyone else does, they hide their problems. Like this individual said, the higher time frame analysis and commentary I'm really strong in. Well, that's good. Thanks for the report card. That wasn't necessary, because I already know that it's accurate. That was the whole point of doing it. I point, you shoot. That's not going to continue forever, as I mentioned before we changed into the 2020 year. This is the last year for that. I'm going to take you down a different path. And for some of you that are just now starting, that may be scary. Like, oh no, I'm not going to have that crutch. You're going to have something else in its place. But I don't want any of you to grow dependent and rely on my opinion about what the market's going to do every single week, whether it be the midweek or the weekend edition, because that's not what this mentorship was designed for. It's designed to create and promote independent thinking and trust in your own analysis and your views on the marketplace. You'll trust those over mine. Some of the folks that are first-year mentorship students and now charter members, multiple-year charter members, I love the emails I get from some of them. And they say, look, I don't really like to look at your analysis or views until the next week. And it's helped them, because sometimes I'll say something, and that's why I spent so much time on this topic here, because I know that I'm showing you a chart right here, and you're already filling in gaps, and your mind's projecting all these, runs all the way down to 129, and you can't wait to get in here on Sunday and Monday to start shorting cable. Okay. Those individuals that are not thinking that way, okay, at least I know I have one potentially, is thinking that there's no real rhyme or reason to the lower time frame entries, and it leaves the students in confusion. There's absolutely no confusion when you take the natural progression of the higher time frame directional bias, as I'm indicating mine here, before the week starts, I'm looking for that 129. What do I do from now on? I'm watching the opening price at midnight. I want to see some measure of a Judah swing. I want to look at SMT divergence. Is there a bearish divergence that's forming basically between Eurodollar and or the dollar index with the cable market? Does it run away quickly lower, create an imbalance, and then I'll just wait for that fair value gap to trade into? Or does it make a higher high after making a shallow high and creates a bearish breaker? Then I'll trade that to go short. So I don't believe when someone tells me they've been in the mentorship for several years and they're appreciative of the higher time frame, but I leave students in confusion for the lower time frame. That is a lot of nonsense. Okay, it's offensive to me when I read that, because to me, that's someone that has not looked and studied efficiently and listened to the things I've said, because everything I've taught is applicable to all time frames. Institutional order flow, you want to see bearish movement plow through what would otherwise be a bullish order block in other people's eyes. You want to see up close candles provide resistance. You want to see down close candles be traded through. That's institutional order flow. Okay. When you see those signatures in price on the hourly chart and 15-minute time frame, then you know that you still are likely to see that 129 big figure get breached on the downside for cable. So how are you left in confusion? I taught this. This is all in the mentorship. But if you're looking for step by step by step by step, that has not been given to anyone in the mentorship, because that's the trading plans. That's what that purpose is. But I gave the models and left everyone to them for a year, so that way they can gravitate to one that makes more sense to them. And now, starting this coming Saturday, we do the first trading plan as a charter member only. So if you're in here new, if you're in month 6 or 7, you're thinking, oh, man, I'm going to get, this is not for you. You have to wait till you're a charter member, and you'll have access to all 12 of them right away. I was going to try to do, and I tried to do this initially, control the amount of price action models that folks would get, because too many at one time would just, like anything else, it's a lot of information. But now it's like you're a charter member, you get everything all at one time. And I don't have time to be worrying. There's too many people in here, too many members for me to be controlling the flow. So once you're charter, everything in charter you have access to. It's 100% at your fingertips. But as far as what you're supposed to do, when you're supposed to do it, how it looks, what it's supposed to look like in framework, and how to attack it, engage it, that's the trading plan portion of it. Okay, so if you feel a sense of bewilderment about what you're supposed to do, but you can see everything in hindsight, you're actually at the right place. That's where you're supposed to be at right now. That's the stage. If you're a charter member, that's the real, I guess, scheduled level of proficiency that I had in mind for where everyone should be at right now as a charter member. Some of you have grown beyond that and are trading with your own unique models without having me actually spelling it out for you. And that to me is commendable. It's not something that I was expecting a whole lot of folks to be able to do. And admittedly, there isn't. But there are a few of you. Don't feel like you've somehow messed up, or you didn't do it well, or it was too much for you to retain, or you're not smart enough, as one of the guys that sent me an email. You're going to have that epiphany, okay? If you're a charter member, you're going to start seeing the models and the plans flesh out, and then you'll see what it is you're supposed to be doing. You're not going to deviate. You're not going to expand on or add to or tweak to these trading plans. You're forcing yourself to operate in what is provided. That way you'll, over time, and I'm not saying a week or 2 weeks or a couple months, over a year minimum, you're going to see, why am I saying a year? Just like I force everyone over the course of an entire month to do the core content, you see 3 to 4 major shifts in market structure over the course of a year. You see every quarterly shift, you see individually monthly setups, then you see weekly setups, 52 of them, and then you have intra-week setups and daily setups, and it gives you a very nice foundation to use as a I guess, confidence building endeavor. Because when you're new, think about when you first started. For those individuals that are charter members, very specifically those individuals that have never done anything else before in terms of trading, you came into this completely green. You had no idea what was going on, and it was probably very confusing. You probably wanted to quit a couple of times, and you probably second guessed, your willingness to stay with it. And now, looking back, you can see things in price action that you didn't even know that you were going to learn. And that's interesting, isn't it? Because you haven't yet been sat down and shown how to take these specific things and put them in a recipe or an algorithm. And that's what we're going to be doing now. Every single month, the third Saturday of every month at 10 p.m., I'm going to release the trading plan for the respective trading models, the 12 that I gave in Charter Member. Once we do that, there really isn't anything I'm going to do anymore with those models. We'll go in another direction with Charter Member content, but those models are done. I'm not going to be, laboring over them anymore. It's your job to go through them and figure out which one you like. But anyway, I said all that stuff to correct, hopefully, anyone that had like-mindedness about confusion on lower time frames. Because, again, if you're referring to what I did on Twitter and Instagram, you're not going to learn that. I didn't intend to share that. It was just me showing off. So, going forward, I'd like to see cable drop to 129 over the course of this week. It may not do it this very week, but I think that it's likely to do so. If it does, I want to see 129 be breached. I like the idea of the fair value gap that's being shown here. Okay, so we could see it hopefully run through, and then it could act as a mode of resistance in here, because what we remember, this is a fair value gap now. So if it comes back up into that, then and only then this low would be a support broken turn resistance, that idea. Okay, that's the reason why it would act as such. Not because it simply went down there and reversed, but because it has the imbalance that it came down to rebalance. Then this low becomes a factor that would be considered for support turn resistance after being broken. Okay, so what I just gave you was the key that unlocks how to use support and resistance from a retail standpoint. You have to have a narrative behind why that low was even formed. Otherwise, it's just noise. It's not going to provide you a basis to have. I guess I'm running out of words to beat this thing to death. You have to know why that low or high is formed. You just can't say the market turned there and it's always going to be a resistance or support because of that. That's not what's going on. Just like this high here, okay? We have this high and this high here, relative equal highs, and the market trades down. When it came back up, the natural theory is okay, well, this is resistance, so it should go up there and then come back down. It didn't. It ran through it. That's what I teach. I expect you to understand that it's going to run through those equal highs and take that liquidity. Now, does this high become a resistance level because of it? No. Because the narrative was it ran out liquidity here. That was the reason why it formed this high. So the narrative and basis behind this high forming was that of running out liquidity. It's not, what would be viewed as classic resistance forming. Okay, the narrative was it ran liquidity. So this level isn't a level that I would expect it to trade up to and find resistance and then trade lower. That's not what this is. Now, I would expect something like that for here, this high. Not here, because the narrative was it ran out liquidity. Here, this is just a return back and rebalance and back into the mean threshold of a bearish order block. That is a natural resistance level in the form of retail view. Now, if it trades up to this level here, I would expect it to act as resistance, but I don't think it will. I think if it's going to go above, I think if it goes above here, to be honest, if it goes above here, it's going to run these highs and then make an attempt to go for the buy side liquidity. That's the reason why I have these annotations on my chart. I don't flesh it out to this degree because it's a lot. It's like drinking from a fire hose. And while it makes a lot of sense as I'm saying it, it gives you too many things to think about and for some of you apparently worry about. And it fuels more emails to me, and I don't want to do that because I don't have the time to answer the emails on a timely fashion because there's too many of you sending them. And like I said, it sounds like I'm insensitive, but think about it. I'm one person and I can't answer everyone's email. As soon as you send it to me, you're expecting some timely response. I answer everyone's email, but unfortunately, sometimes it's weeks later. And I wish I could. There's not enough time. Okay, there's no time for me to be able to get to every single email and answer everyone's question in any timely manner. So this is the reason why I teach the way I teach, and I talk about the things I talk about. And sometimes, these lessons go on longer than some of you want. And again, you need to align with my delivery of content. I'm not going to align with what you want me to do. Okay, because this stuff is so complex in conceptual theory that you need to have lectures. That's why we do these 2 times a week. You need to be lectured on these things. And it can't be just said, okay, here, it's going to go here, 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 watch this, and it's done. You're not learning from that, except for dependency. And that's not what this is. So for the individual that sent me an email, and I don't remember your name, apologize for that. I did respond to you, but I just want to remind you again, I'm going to deliver the way I want to deliver because it works. And if you want me to spoon feed, I'm not that guy. Okay. I give you what you're looking for, but I'm not going to spell it out in the shortest time frame and say here, 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 and then that's it. Because my idea of this mentorship is teaching you how to do it yourself, not follow me, do what I tell you to do. That's not what this is. That's not mentorship. That's signal providing. And I don't do that. All right, so moving on, the last chart here, 15-minute time frame GBP. You can see the deferred rebalance from the 60-minute chart. You can see consequent encroachment. Beautiful. You wouldn't otherwise see it here. You might want to see it from here to here, or maybe from here to here. You might have had that in mind. But consequent encroachment is formed from the basis of the 60-minute fair value gap. And if you haven't noticed, I didn't make a mention of this on the euro-dollar chart, but on the 15-minute time frame, I had the 7 a.m. on Wednesday annotation that there's no new positions taken into account for the non-farm payroll conditions. We don't trade any new position. That's a general rule, first week of the month, every month, that 7 a.m., if we haven't had a trade on yet, we don't put on one. The buy-side liquidity pool here was purged on Thursday, ran through that, and aggressive rundown into, and it just went down less than 1 pip, less than 1 pip variance from the framework that creates the fair value gap in here. And then we had the market move higher. This is the top of the old fair value gap. There's another level here I took out, remember, going back to the hourly chart. And let me do, because I know I probably just confused you. This candle's high right there. Okay, there's a line that I had last Wednesday, or just Wednesday that we just had the midweek review on. There was a line there on that one as well. Okay, that's what's missing. And you would have that line in here somewhere as well. But the reaction here on the top of the fair value gap, the higher fair value gap, before we got down to the lower one here, look at how much sensitivity we had there. Here, all in here, here, and look how it's riding that level. Okay, you're going to tell me that's classic support resistance? It's not. Okay, it's the algorithm remembering something that it has framed in its initial delivery. You'll learn more about this stuff. I'm just going to say that, and then we're going to lead the discussion. But nonetheless, I'd like to see it trade with a gap down on Sunday, and then fill the gap and then go lower. That's what I'd like to see happen. Anything back above this area in here is problematic for shorting, and until that's the case, I'm bearish on GBP. And I think that's going to be it, folks. I will catch up with you by way of Twitter, I'm sure. And if not, we'll talk again on Wednesday at our midweek review for the SIGUEME Mentorship. Enjoy your weekend. Be safe.